are now tuned into the Money Level Show.
So transitioning to gold, we've seen the yellow metal actually rise significantly. It's back close to 2,400 again. I don't think it's been below 2,300 in a little while. And this is obviously measured in dollars, right? And so when we look at gold, I mean, you have central banks buying, you have more demand out of China, and things of that nature. Are there any other tailwinds for gold that you're seeing? Obviously,
Right.
rate cuts. I don't know if you think rates
We
coming down.
could talk for an hour on just this, but first, yeah, it is interesting that 2,300 seems to be the new 2,000 in terms of a floor. And I'm not a technical analyst, but it seems to hold up pretty well to those tests. And that's interesting. There's appetite out there. I mean, the charts are charts of prices. Markets prices, that is information, Adam Smith's invisible hand. There is a buyer out there, right, at that level. So that's interesting that's a fact in our world right now. So this connects to the start of this interview, right? I was right about gold, but not for the reasons I thought. The good news on that is that those reasons that I thought, they're all still on the table. Like, I'm expecting, and I've felt a little bit like the little boy who cried wolf, or in my case, since Lobo means wolf in Spanish, I feel like the little wolf who cried human. Inside joke, sorry. I've been on Team Hardline. I've been expecting the Fed to break things, that this record-breaking rate hiking cycle would have more consequences than just a few mid-sized banks going out of business. And the longer it's been since nothing big has blown up, the more people are saying, Lobo, you're wrong, you're a perma-bear. If we haven't had a recession by now, we're not going to have one. There's so much I could say on this, but very quickly, the long and variable lags, everybody acknowledges, even the other side acknowledges, the average length of one of those in the U.S. economy is around 27 months, which between the rate hiking cycle start puts us at basically now. So just historically, it's incorrect to say that the recession is overdue. Like, just now we're getting to the point where it's average length. And starting from now forward, it becomes overdue. So I'm still expecting a recession. Recessions tend to be good for gold. I still think that if nothing else, like nothing else really breaks, makes the Fed loosen, and so that's bullish for gold. But instead of having this bullish tailwind, which was why I was bullish for 2024, like 7 or 8 months ago, so that's still bullish now on top of where we are. But instead of starting at 19 to 2,000, we're starting at 23 to 2,400 going into that scenario. So I think that's extremely optimistic. I didn't even want to say a price target because it sounds like I'm one of these tinfoil hat guys if I give you a number. But I think the audience can tell where I'm going with this. What's at 20%, which would be a huge move for gold. It often swings like 50% from a cyclical low to a peak. What would that do given our starting point? So that's pretty exciting. But let's say I'm completely wrong about all this. Team soft landing is right, or even team no landing. Lobo, you're out to lunch, you're a perma bear, fine. The Fed is still guiding cuts. Those are bullish for gold anyway. Like, even if I'm completely wrong, ultimately, I'm a due diligence guy. I'm not an economist, right? My shtick is what we started with, all those company evaluations. Not an economist, but people ask what I think, so I'm answering. Anyway, if I'm completely wrong, but things go the way the mainstream expects, that's still bullish for gold. Rate cuts are, we can see it on the charts. Any news happens, any economic news happens, this last week's employment data, that's bad news for Main Street, it's good news for Wall Street because the people think the Fed's going to cut rates. And you see the gold-dollar exchange rate go up when that happens. So the mainstream is telling us they're bullish for gold. Even places like Bank of America have a $3,000 target for gold for this year. So that's if the contra Lobo position is still bullish for gold, that's pretty darn bullish.
Yeah, sounds pretty like a win-win situation, regardless of how it plays out.
And you sound like a perma bull if you say that. Oh, there's no way it can. Of course, there's always something that could go
yeah.
wrong. But what are the probable scenarios? Like what would it take to really whack gold down when we do have the central bank gold buy? And by the way, we just had the news out that China, for a second month in a row, officially at least, didn't buy any more gold. And so that was in the month of June. They say they didn't buy any gold in the month of June, but that didn't stop gold from going back up to 2,400. So this whole narrative that it's all because of China buying, that's clearly not it. And that's really interesting to me because that means somebody else is buying. It's the Indian. Well, let's not oversimplify things. I think the evidence is that we're in a world right now where even mainstream investors are starting to say, you know what, hedging a little bit with gold might not be a bad idea. Mm-hmm. We've got two hot wars, either of which could become World War III. You have this economic troubles. We have, even a soft landing is still a landing, right? It's still a recession. There's so many things out there that could have just not tinfoil hats or gold bugs like me, but normal people saying, you know what? A little bit of hedge with gold. Look how well gold is doing. A little bit of hedge there. That could be a good thing. And this is another Rick Rule thing. If the 4 to 5 decade average portfolio allocation to gold globally is 2%, and it's been 0.5% in recent years, then a mere reversion to mean, not a mania, but just a reversion to mean would be 4x demand for gold. Mm-hmm. So if that's what's happening now, like if it's not just China, if it's the global asset allocation beginning to say, let's hedge a little bit with gold, that is huge for gold. Mm-hmm. Anyway, sorry, I'm getting off and I'm taking your show over here, but let me answer the question. So what could knock gold back? I think it would really take the no landing scenario. And even that, I think it would take, like, peace would have to break out or something like that. I mean, it's hard for me to say there's no way gold can go down, but I'm looking at the world we live in, and it's hard for me to see a scenario where everybody around the world says, you know what, everything is just so peaceful and nice and risk-free. I don't need no stinking safe haven assets. Yeah, I just don't see that world.
Mm-hmm. So yeah, that makes total sense. So with U.S., we have a lot of deficits. We have unfunded liabilities, hundreds of trillions, right? And I know in the next decade, like Social Security, that's going to be like a big thing that comes up since that legislation hasn't been touched since the 80s. And I'm just wondering, okay, what is gold's role for like the average person, considering these dynamics with government spending out of control, deficits,
Well, okay, so again, I'm a due diligence guy. Mm-hmm. People hire me for a second opinion on the stocks they're thinking about investing in. That's what I get paid for, or for ideas. But people ask, so that's and there's a real, like, again, to be honest and confront this issue head on without just being a cheerleader for gold or anything else. You got to look at it and say, okay, the debt deficits, all these issues that I remember. I was only a newspaper kid at the time, but I remember the rhetoric back in the 70s and about how terrible it was that the national debt was $1 trillion or approaching $1 trillion at the time. Just $1 trillion. Mm-hmm. That's chump change these days between friends, right? We'll be 50 trillion in the next 10 years or whatever it is that the government admits. Mm-hmm. Not the tinfoil hat story. That's what the government thinks we're going to be. So, people were talking about profligate governments and Congress and all these terrible things and the national debt and what a crisis it was 50 years ago plus. And here we are, and the world hasn't come to an end. So it's kind of difficult to say, yeah, it's gone vertical, it's got to crash. This is, a bubble in search for a pin and all that. I think all of those things I just said are true. It can't go vertical forever. Like, that is mathematically impossible. Mm-hmm. And yet, people said similar things 50 years ago, and here we are. So I gotta say, it makes me cautious. And personally, that, like, okay, I was a shoeshine boy, and I wasn't buying gold, I was buying silver in the big 1980s spike. I participated as a kid, but I remember those lessons. But my more recent lessons are really the big crash in 2008, the global financial crisis. And my mentors, some of them here at this conference, it was really hard to see how the powers that be could kick that can down the road. Like at that point where, they say checks came like within 48 hours of not clearing the banking system. It was so bad that many of my teachers, like they really thought this was it. There's no way, like in 2009, they can paper this over. The house of cards is coming down. And it didn't. We're going on 15 years later, and it didn't. So it's very difficult for me to say, yes, this is unsustainable. It must be done. And yet, at some point, that ice cracks. There's the saying of, how did you go broke? Slowly at first and then all at once. I think this is worse than that. Like slowly at first and all at once. I think that applies to the US labor market. Like we're seeing it now, slowly at first and then all at once. But this potential crash of the system as we know it, this fiat money bubble, I don't think there's a slowly at first. I think it's just all at once. Like everybody has faith until suddenly the kid says the emperor has no clothes.
Yeah.
And so when is that going to happen? I can't tell you. I have this feeling it's not right away. The dollar milkshake guy is probably right. This is going to take some decades.
Yeah.
But that doesn't mean we don't know what to do or everything's fine for the next 10 years. The gold dollar exchange rate right now is telling us something important. About all fiat currencies, really.
Yeah, for sure. Yeah, that's important. So you view gold as more of a insurance.
Absolutely. It's not a speculation. This is something Doug Casey taught me, right? You own gold for prudence. I literally view gold as my savings. Like I have a checking account. I have no savings account. If I'm going to put something away for savings, I buy bullion. That is my financial setup. Right? So it's not a speculation. I don't buy gold because I think it's going higher. I buy it because it's gold, right? And if the bubble bursts, I'll still have real money.
Yeah.
Right. So if I wanted to speculate on the gold dollar exchange, and I keep calling it that for anybody that doesn't know, because I think it's a mistake to call it the gold price. It's not just another commodity like pork bellies or even copper.
Yeah.
Gold is money. It has been for thousands of years. So I see it as a forex transaction. I exchange dollars for a different currency that I believe in, or money that I believe in, gold. Anyway, but if I want to speculate on the exchange rate going up, well, that's what the stocks are for. Because why just buy the thing itself when I can get leverage with the stocks? And that has seemed broken in recent years since 2020. But happily, we're seeing that leverage come back now this year. So yes, gold stocks are working again, and I'm happy to have a lot of them in my portfolio.
That's good. So a lot of people have issues with the gold stocks. I mean, I got shaken out of some of the silver stocks a little while ago, and now more focused on royalty streaming, just to reduce headache at least. So like with the miners, right? Obviously, there's winners and losers.
Yes.
And so you offer a service to identify which ones are most likely going to be the winners. Because sometimes I do think that people just invest in something because they know it, they know the company, or it's a big name or whatnot, and it just doesn't work out, and so some people get frustrated and shaken out because of that. And so how do you obviously you have a service, and how do you kind of filter through some of that, like just if the audience is looking for.
So boy, that could be. Let me say a couple things. One is, if I'm very risk averse, let's say I'm a retiree on fixed income, still with serious responsibilities, or maybe some decades ahead, and I really can't afford to lose my nest egg, then maybe I don't want to speculate at all. I think the gold dollar exchange rate or silver or uranium is going up. You could buy an ETF for just the metal. It's not the same as savings because you don't own the thing itself, right? You can't hold it in your hand. But it gets you out of the fiat currency. It's a way to participate with very little risk. Gold can't go bankrupt. It can go down, it can go up, but you can't discover an endangered mosquito on your property and suddenly have nothing, right, when they shut you down. That doesn't happen to the commodity itself. The next closest thing is, I think, the royalty space, as you were saying. You might say, well, the miners, the big producers, but no, they still have a lot of risk. The royalty space is better. you have a basket by virtue of it being a royalty company. The royalty company typically gets paid whether the mine makes money or not. There are, most are net smelter return royalties. There are other royalties, gross sales, net sales. There are different royalties out there. But generally speaking, the royalty company gets paid whether the miner makes money or not. So that gives you a whole extra layer of protection, but still a little bit more leverage than just buying the metal or the commodity itself. And then there's a whole spectrum, right? You continue ramping up the risk. You can go with the producers.
Explorers, that's part of the top.
Right, and then the explorers would be the high risk. If you're hunting for 10 baggers, that's where you go. And you know what? I used to say, if you're 19, got no kids, why not? You can speculate but now I've amended that to say, if you're 19 or 90, like why not? 90, your kids should be grown up by now. Right? Yeah. Your grandkids should be grown up by now. Yeah. Why not?
Yeah, I mean, and we have some people up in age, at the symposium that still go around and they getting into these companies. So definitely, there's no age limit for them.
Well, and if you, with your accumulated decades of experience, you make some really good picks, and you accumulate some serious capital, even advanced age is no reason not to have goals. And capital can be deployed. It can create things. It can be used in so many ways. And I don't just mean charity, endow a foundation or something. You can invest directly in things that Elon Musk wants people to go to Mars. So instead of going around begging for money or getting the government to do it or setting up a nonprofit, he built a company. He's just doing it because he's got the money. He took billions of his own money to just build it because he could. Okay, that's maybe a bit larger goal than most people will embrace when they're 90 years old. But I'm just saying, if you're not on death's doorstep, forgive me for being so blunt, I think it's a wonderful thing to have worthy goals and to accumulate capital to make them real.
Yeah.
Don't give up on having an impact on the world.
Yeah, that makes total sense. So just before we leave, just kind of a fun investment question. Share a time when you've made a really good trade and a really bad trade. You don't have to mention the company, but what were the lessons you learned from those two instances?
Well, I can mention the companies because they no longer exist, or at least not directly. The really good one would be AUEX Ventures, which then got taken over by partner Frontier Gold, which got taken over by Newmont. There were spinouts along the way, one of which became Renaissance, which now is Origin. You like royalty companies. I'm not recommending that one. I'm talking AUEX. And I did not get in early, pre-discovery. I didn't bet on this just because of the people or Nevada location or something. I got in after the discovery. This is important because it greatly reduced the risk. And the discovery wasn't just one hole. Woohoo, yay, the stock goes up 10x on this one hole. It was 6, 5 of which hit. If I'm remembering, maybe it wasn't exactly that, but it was something like that. But as I recall, it was 6 holes, offensive holes. And one of them clipped the edge and the other one was like boom, 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 boom. They all hit. You could tell it was something there. And okay, the stock doubled or something on that. But then that went on to become 20x. And if you include all the spinouts and free shares we got in this and the takeovers and all this stuff, I don't actually know how many X that went to. We'd have to recalculate it today. And it's still going because Origin is not done yet. That's almost 20 years ago or more than 15. And it just like the Energizer Bunny, it just keeps paying and paying and paying. So the takeaway isn't just, we got really lucky. The takeaway is, that was a phenomenal bet because you had not just a hole, which could have been a fluke, but you had a set of holes that really, I think, communicated very high odds of something significant here. And the valuation, was payday yet to come. The opposite of that would be, there's a free article on the website called My 2 Greatest Mistakes and What You Can Learn From Them. So you get 2 for 1. One was Rubicon, and the other one was Banks Island Gold. Both of these are examples of companies that built a mine without a feasibility study. And I probably don't need to say much more, but both of these were like these are perhaps the two worst outcomes in my whole career. Banks Island was bad because it basically went to zero, bankrupt the company. And specifically, like it was this feasibility study was going to cost more than the capex. Mm-hmm. So you could see why they're like, it's just there, like it's right on surface. Let's just mine it, and we'll pay for more stuff, right? But then they mined it, and it turned out there were as I recall, garnets in the rock that weighed the same as the gold and pyrite, and they were doing gravity separation. So that meant that instead of just getting the gold out with the gravity separation, you got the gold and the garnets. Mm. And so your 12 grams per ton turned into 4 grams per ton because of all this other stuff that came out with your product. Just the sort of thing that a feasibility study, proper work, would have determined in advance. But they didn't do it. Rubicon was somewhat similar. It was deep. And they're like, it's going to be so expensive to drill this thing off from surface. It would literally cost as much as building a mine. So let's just build it, and then we'll further define it once we're underground. So they did that, and they got underground, and it turns out the deposit wasn't there, or at least 90% of it wasn't there. Like literally 90% of the ounces got written off once they started mining. Wow. So yeah, that is a major red flag for me now. You'll see this in my takes, my company evaluations. Any company that starts building the mine without a feasibility study, and they may have great reasons, theyll say, well, gee, that'll cost more than, it's right there. We can just mine it. For whatever it's worth, those are my two biggest mistakes.
True. Yeah, we should have learned from Lobo's mistakes. I'm gonna be sure to take heed of that. Appreciate you sharing the wisdom with us, because some people may they can fall into that trap. So we just don't want to fall into the trap.
That's right.
So where can people find more about you, and then more about the work you do, and where can they follow you at? And then appreciate
Sure. Well, thanks for the question. IndependentSpeculator.com. I always recommend everybody start with a free weekly newsletter. And you may or may not agree with me. The one promise I will make is that if you sign up, I will not spam you with a flood of daily advertisements. I hate that. You get one email per week, and then you see whether you want to hire me as a due diligence guy. As far as that goes, as we were saying earlier, sign up and you'll find out. You could start at $50 a month. It's not a fortune. If you're serious about making serious money, that gives you full access to the database. We have 800 companies under coverage now. And, we don't get everything right, but they're all independent. Like they're not paid for by any company. It's my take on these companies. And 90% of them have a thumbs down. And you can sort that database. Like if you're interested in gold junior explorers, you can sort for companies like that have a thumbs up. Or if you want silver producers not in Mexico, like you can find that. Mm-hmm. Right? So it's not a typical newsletter. Check it out.
Got it. You all be sure to check that out. I will be sure to link to it in the description. Thank you, Lobo, for coming on, spending your time with us. Always appreciate it.
Thank you.